Hello, good evening, everybody. My name is Jeanette Alvarado, and I am with Group 4. My group members include Christian Castro, Arisbet Hernandez, and Adrian Ramos. In our case study, we'll be breaking down the fraud case of Koss Corporation and how its former Vice President of Finance was able to embezzle a total of $34 million from a small corporate business. Before we begin getting into our analysis of this case study, I want to give a little background of Koss Corporation and who Sujata Suchdev was. Koss Corporation is an American company located in Milwaukee, Wisconsin. It was founded in 1953 by John Koss after he pioneered the stereo headphone. Due to diversification in the 1980s, Koss Corporation almost succumbed to bankruptcy. However, it was able to survive. Koss is a publicly traded company, and over half its stock is owned by management and employees. In 1991, Michael Koss, the son and founder of John Koss, took over as president and chief financial officer. His brother Johnny Koss and his brother-in-law Michael Moore are also very involved with leading the corporation. This corporation is made up of approximately 70 employees. Just based off that information, there are big red flags. Number one, the corporation is no stranger to financial troubles. And number two, management are all family members and speaks into the oversight and governance of the organization. Now I gave you a brief overview of Koss Corporation. Let's get into Sue and how she embezzled $34 million over a 12-year span. This case is a very interesting case study because of how obvious this fraud was and the negligence from all parties involved. To paint a picture of who Sue was, she was this very extravagant person. And from the article I read on her, she was known to be quite a diva. She made herself out to be from this elite lineage of Indian immigrants, even though it was all one big lie, because she was funding her lifestyle with Koss funds. She used company funds to pay her American Express credit card, where she would buy designer clothing, furs, purses, jewelry, cars, china sets, furniture, money for home improvements, and travel expenses. A very interesting fact about Sue was how she was this very big philanthropist and organized this very large, extravagant auctions where she would buy all the items if they were not sold. Of course, using company funds. Aside from having issues with alcoholism and shopping addiction, she had a power over those around her, to include the executives of the company and the accountants below her. The corporation executives had a very relaxed oversight and trusted Sue way too much. It was even said she would run all over Michael Koss when he would ask her for any financials, basically trying to do her job. Another enabler of Sue's fraud was Koss employees Julie, who was the senior accountant, and the junior accountant Tracy. The plea deal Sue signed admits she told subordinates to make fraudulent entries in company books, concealing the embezzlement by overstating assets, the cost of sales and expenses, and understating sales and liabilities. In addition, Sue had an out-of-office relationship with Koss independent accountant. In 2006, she co-chaired a fundraising gala for Big Sisters, Big Brothers with one of Grant Thornton's partners. In December 2010, she was arrested after a tip was sent and unfolded her fraudulent activities. She was indicted on 6 counts of felony wire fraud. In the end, Grant Thornton, who audited Koss's books, agreed in 2013 to pay Koss $8.5 million. In 2016, American Express agreed to pay Koss $3 million to settle its lawsuit. Koss had sued Park Bank, which handled the corporate company's accounts, alleging it should have alerted Koss to Sue's misappropriation of company funds. However, that case was dismissed. Now that you guys have an understanding of who Koss Corporation is and how Sue was able to fool those around her, our team will now provide an in-depth analysis of this case study.
Hello everyone, my name is Christian and I'm going to be presenting on the fraud triangle. All right, so as we all know, there's three parts of the fraud triangle. There's perceived opportunity, perceived need or pressure, and rationalization. For the perceived opportunity, internal controls were weak. Nobody checked the wire transfers, even if they were large amounts, no one would check them. They had a petty cash account that no one reviewed. The petty cash account was used to make small purchases, and it would automatically refill itself if it got below a certain balance. And they didn't perform any monthly reconciliations. So if there was something wrong, they would never find out until it was too late. So now with all these weak controls, it created an opportunity for Sheshdev to go ahead and commit the fraud because she knew that management doesn't review anything. So it created the opportunity to do it. So the perceived need, Sheshdev wanted to live a luxurious lifestyle. There wasn't really any pressure. She wasn't going to go bankrupt. She wasn't in the brink of losing everything. She only did it because she wanted that luxury lifestyle. The rationalization, Sheshdev testified on having bipolarism to justify her online spending spree. She blamed the bipolarism to justify her spending spree. Category of fraud. This type of fraud falls under two categories. The first one is asset misappropriation. The median loss for this is 100,000. The median loss for 4 years is 430,000. And the actual amount that she stole was 34 million. This is way more than the median loss. And this is an asset misappropriation because they used the petty cash account to pay off their bills, their credit card bills. And then not only did they misappropriate assets, they also created financial statement fraud. The median loss is 954,000. The median loss for 4 years is 430,000. The actual amount was 34 million. So Sue would create false financial statements just to cover up her fraud. She would ask the accounting department to enter fake entries so that the entries she would make would look like legitimate business entries.
Hello again, everybody. As Christian already went over, the median financial loss within this fraud category, according to a CFE report to the nations, is $100,000 for asset misappropriation, which is significantly higher than that was lost in this case. The loss was 33,900,000 more than the median loss. In comparison, the median loss for financial statement fraud is 954,000, which is still significantly higher than what was lost in this case. The loss was $33,046,000, more than the median loss. The figures in the slide just paints a picture of the magnitude of the fraud and how it severely impacted this small corporation. What's interesting is that Sue had a very high role in this company and was easily making a six-figure salary, and her husband was a doctor and professor, so they were really well off. So basically, she was stealing so much from her co-workers because most of the executives owned a high share in the company. I will now move on how the fraud was discovered. The fraud was discovered when somebody working at American Express noticed very suspicious activity. They noticed that the Vice President of Finance and the Principal Accounting Officer had been wiring funds from Koss Corporation's account into her personal American Express account. American Express then tipped off the FBI and Koss Corporation, the executives, how company funds were being used to pay for personal credit cards and bills. According to the AMCF report to the nations, 43% of schemes are detected by tip. Fraud training awareness is very important for an organization because it can lower the risk of fraud. As in this case, it could have come within the organization, especially because collusion was involved. And if somebody had spoken up, it could have lowered that impact on this small business and could have been discovered a lot sooner. Now I'll pass it on to my next group member.
Hi, good afternoon. I'm going to talk about Sagdiva's punishment. Sujata Sagdiva served as VP Finance Secretary and Principal Accounting Officer for 15 years. However, for 5 years, she embezzled nearly half of Koss Corporation's pre-tax earnings. On December 18, 2009, Sagdiva's embezzlement was discovered because an employee of American Express reported to the FBI that Sagdiva made multiple charges from Koss's bank account to pay her debt with this credit card company. She pleaded guilty to 6 felony accounts that carried a maximum penalty of 120 years in jail, but 15 to 20 years is appropriate under federal sentencing guidelines and was ordered by U.S. District Judge to pay at least $500 per month to Koss towards the $34 million in restitution. 15 to 20 years was the sentence Michael J. Koss wanted for Sagdiva, but she was sentenced to 11 years in prison in 2010 by the U.S. District Court Judge Lynn Adelman in Milwaukee. Her husband filed a divorce. Most of her assets were confiscated, including a 2007 Mercedes-Benz timeshares, jewelry, shoes, furs, and all kinds of luxury items. Sagdiva served 6 years of her 11 years sentence because she cooperated with authorities since she was uncovered. Her attorney claimed she was bipolar and suffered from compulsive shopping disorder and alcoholism. Koss charged Grant Thornton with negligence for not fighting Sagdiva's embezzlement during those years. Melissa Coppel, um, a former partner of Grant Thornton who oversaw audits at Koss Corporation and was in charge of the audit engagement, was banned by the PCAOB because of her lack of professional judgment and due diligence. The board of PCAOB limited and prohibited Coppel from practicing audit in any public engagement for 2 years. The SEC banned Coppel from practicing before this organization for 5 years and fined her with $10,000. In 2013, Koss Corporation collected 8.5 million in a settlement from former auditor firm Grant Thornton LLP. Sagdiva was released from prison in 2017, just serving 6 years because she cooperated with federal prosecutors, meaning that she got out 33 months earlier. Koss Corporation also sued American Express, claiming it failed to report about 20 million Sagdiva 20 million that Sagdiva paid for her credit card with Koss money. The suit was dismissed. The punishment for Sagdiva was not fair. Her sentence was reduced due to her cooperation with authorities. Her lack of ethics and lucre provoked a company to lose millions and they got a bad reputation. While she was living a life of luxury, the company was losing its pre-tax earnings. Her family suffered as well because of the embezzlement. The restitution of $500 per month is not enough to recover the money she stole. In addition, the SEC that banned the auditor from practicing the profession for 5 years, that doesn't mean that she will apply ethics standards or in audit procedures if she comes to audit again.
All right, moving to the fraud risk assessment, we came up with 11 risks: lack of management supervision, absence of ethical and fraud policies, lack of accounts payable controls, lack of segregation of duties, outdated computerized accounting systems, management's failure to review financial statements, unprepared account reconciliations, auditors' failure to obtain an understanding of cost internal controls, wire transfer fraud, recording fraudulent transactions in general ledger, and collusion. So out of the 11 here, the 4 that we believe are the most crucial that contributed to the fraud was the lack of segregation of duties, lack of management supervision, collusion, and unprepared account reconciliations. Now, these are not in any specific order. These are just the top 4 we believe really contributed to the fraud. Management didn't supervise its employees and didn't do any bank reconciliations. And Sue, she did way too many jobs. They could have done a little bit better by separating some of her duties. Not just that, but collusion between her and her coworker that really led up to this fraud to be way bigger than what it was supposed to. You had 2 people working together to cover up this fraud, and it really worked for them. The only reason why it worked for them so good was because management was just lacking on the supervision. They didn't supervise their employees well enough, and I think that's what really screwed them over.
I will be discussing the coastal framework of this case. For the control environment, the board of directors and senior management have a major influence in the control environment because they are creating the tone at the top by setting the standards for the organization and its employees. In examining this case, the company's board of directors, CEO, and supervisors were not providing the appropriate responsibilities for the governance and oversight over the company, for which exemplifies a low tone at the top. Policies and procedures should have been in place to enforce the employee code of conduct and the consequences of misconduct of an employee's unethical behavior. The CEO and board of directors are also responsible to ensure the policy has a section that a risk assessment is performed and that the appropriate and competent auditors are performing the annual audit and reviewing all financials for the company. Senior management in this case should have kept a close eye on the accounting department and ensured there was a structure of controls in place and enforcing them. Lack of oversight and weak internal controls set the tone at the top low, as stated. As for the auditors, Grant Thornton, even though not required to due to Section 404B of the SOX Act, which states that if the company's market cap is below 75 million, the auditors aren't required to review internal controls. However, Grant should have still reviewed the internal controls for any discrepancies or financial reporting and thoroughly performed journal entry testing. For the risk assessment, a risk assessment is a crucial part of an organization's objective setting because it allows for the company to evaluate the risk they face if an event were to present itself. There was no indication of any form of a risk assessment being performed in the company. Due to the trust the CEO and board of directors had in Sue, executives and senior management neglected to properly evaluate the weaknesses in its accounting department and identified that there was no separation of duties. If a proper assessment was done, they would have seen that there were many control weaknesses in the accounting department and no separation of duties. Koss lacked accounting policies that should have been in place to prevent the fraud. There was no oversight of Sue's department work or performance. The control activities that should have been implemented by Koss are: there should have been segregation of duties in the accounting department. It is necessary to have various individuals perform different tasks in the accounting department so that the threat of fraud is minimized. This is to ensure that the same person is not responsible for recording journal entries, making electronic transfers, and reconciling the bank accounts. The company should have policies and procedures and implement them to clearly define the tone at the top. The company should also have oversight of those charged with governance. Controls are necessary no matter how trustworthy people might seem, especially within a company such as Koss. Supervisors and management should routinely monitor an employee's job and the performance of their tasks. The auditors need to evaluate and review the internal controls the company has in place. Expenditures and wire transfers need to be approved by more than one individual. The company should have an ethics policy and enforce it. Ethics are crucial in order to maintain guidelines for all employees and to create a culture of integrity, honesty, and ethical behavior. Additionally, substantive audit procedures need to be performed while auditing expenses in order to support expenditures and wire transfers. This could be done by attaining all supporting documents such as invoices, voucher slips, purchase orders for the expense being incurred. There needs to be a whistleblower policy as well in the process where employees can alert the executives when they suspect fraudulent activity may be occurring. For the information and communication part of the COSO framework, all activities such as operating, reporting, and compliance activities of the company must be discussed, assessed, and financially analyzed to ensure they are conducting the required oversight responsibilities for the company. To effectively prevent or detect a similar fraud from occurring, the company should ensure the CEO and board of directors thoroughly review and analyze all financial statements. External and internal monitoring activities of the risks and findings noted in the independent valuation of all fiscal and compliance activities must be presented to the CFO, board of directors, and upper management. Lastly, monitoring. In order to verify controls are effective, the CEO, board of directors, and supervisors should routinely review documentation and accounting records to verify that the controls in place are executed correctly and are effective. There needs to be a review and complete communication between financial personnel, supervisors, and management to look at the financial health of a company. Management is responsible to ensure that their department areas are operating effectively and communicating that information with the auditor. It is important that management communicates this to the audit function so that they can implement their concerns when a risk assessment is developed.
Hi everybody, in this slide I'll be going over the audit report findings that we will note in our audit report. So there's four findings that we found. It was the lack of oversight in corporate governance, the audit risk and conflict of interest, collusion, and fraud. I'll go ahead and pass it to my next group member.
Now I'm going to talk about the III performance standards that we applied in the audit. The standard 2200 engagement planning. Prior to starting our audit, we used standard 2200 by planning the engagement. The first thing we did was identify the objectives of the engagement. Our overall objective was to evaluate the design of internal controls and why fraud occurred within Koss Corporation. Another objective was to assess the compliance with the previous external auditors against the IIA and the IICPA standards. The next objective for our audit was to determine the performance of employees and overall governance and oversight. Lastly, our objective for this engagement was to determine the effectiveness and efficiency of corporate policy with Koss Corporation. Our next step of the planning stage was to perform a risk assessment and identify the key controls, which Christian has previously gone over. Then our team developed our plan and allocated our resources so we could perform this engagement. The 2300 standard performing the engagement, we gather evidence from the company through physical verification of assets, including bank accounts, cash, and review bank reconciliations to verify if the numbers in the books match the numbers in the bank account statements. Also, we interview employees from the accounting department to understand the processes they perform in areas such as accounts payables, and accounts receivables. We will take these interviews as oral evidence. We also analyze controls using the accounting system and testing them. For example, we verify what controls the company uses to avoid employees sharing their passwords if they have limited access to the system, etc. Furthermore, we reviewed all policies to investigate proper separation of duties and ensure detection of fraud can be mitigated through HR policies and employees' handbooks. The standard 2400 communicating results, we applied the standard 2400 when communicating our findings of the evidence gathered to the CEO, Michael Koss. Our findings show that internal controls were not effective. We identified several risks, among them lack of management, there is no existence of ethical and fraud policies, lack of segregation of duties, lack of accounts payable controls, outdated computerized accounting system, no account reconciliations are performed, and recording of unapproved journal entries in the accounting system. Then the standard 2500 monitoring process, we apply this standard by communicating with the CEO about the observations of the evidence gathered before, and he had to implement corrective actions to improve the company's internal controls and make them effective. We communicated to him the risk rating in the fraud risk assessment and all recommendations. We monitored every quarter that the corrective actions were taken, and we supervised the status of these actions. And finally, the standard 2600, communicating the acceptance of risk. CEO Michael Koss accepted the level of risks. The risks were significant because it affected the reputation of Koss Corporation and resulted not only in embezzlement but in fines by the SEC and the PCAOB. Since there were highly significant risks, they were communicated to the board of directors in meeting and documented in minutes for future follow-ups. Thank you so much.